Did you know that there is a secret tax saving season? In this video, I will explain how you can legitimately retain every dollar you earn in 2024 and pay no taxes on it. If that sounds too good to be true, I have the strategies that will transform your financial gain. Immediately join the savvy few in on the secret to maxing out your retirement account by making the maximum contribution to traditional 401k plans. This is a tax-advantaged retirement account that allows you to make an annual contribution of up to $223,000 before taxes. For clarity, for every dollar you contribute, your taxable income will decrease by the same amount. As a result, you will report a lower income, pay less in taxes, and have additional funds available for investment. To illustrate, consider the following example. Assuming an annual income of $100,000 and a contribution of $225,000 to a traditional 401k retirement plan, the remaining balance is $75,000. In this case, the only tax liability is on the amount remaining after the contributions to the 401k, so you will be taxed as if your annual income were $75,000. Given that you are in the 22% tax bracket, this represents an immediate savings of $5,500. Certain employers may even match $400 on contributions dollar for dollar, tripling a risk-free investment up to a certain threshold. You may be thinking that this seems too good to be true, and there must be a catch. Well, you are correct in assuming that there is a catch. Eventually, when you withdraw money from the account in retirement, which is typically around age 59, you will be required to pay taxes. Furthermore, the tax bracket for future contributions may be significantly higher than it is now. In my opinion, you should only use this method in two situations. First, when your employer matches your 401k plan dollar amount. Having a 401k makes a lot of sense if you're currently in a high tax bracket and probably will retire at a lower tax bracket. Then you may simply profit from the difference. However, for most people, a 401k is an excellent resource for lowering your tax bill. This also leads us to the next way we can lower our tax bill. And I'm talking, of course, about health savings accounts or an HSA. They are tax-advantaged accounts specifically designed to cover any out-of-pocket medical expenses or charges that you may incur throughout your life. Another advantage of HS is that you can invest the money you contribute to increase your tax savings even further. Here are a few reasons why I consider this to be one of the best tax-advantaged accounts to ever exist. First, you don't need to pay taxes on any money you contribute to this account, and you can contribute up to $4,150 every year in 2024. Second, you will not be taxed on the money that you use if it's on health-related expenses, which we will face at some point in our lives. It's basically like you're getting tax-free money to invest without having to pay taxes, but you have to spend it on the right expenses. And with a 22% tax rate, that's a net saving of $11,000 instantly for perhaps 10 minutes of work. However, keep in mind that in order to qualify for this tax advantage account, you must have what is called a high deductible health plan 2024, which means you have a deductible of at least $1,600 for individuals and $3,200 for families. So if you fulfill this criterion, then I suggest you use this method since it's one of the finest methods to save money on your taxes for the least amount of work. The next way to lower our tax bill and save money is by using one of the largest U.S. tax breaks in existence called long-term capital gains tax rate. Just think about this. If you buy an investment and sell it within 12 months, the profit you gain is considered as earned income and is taxed at your ordinary income level, which could be as high as 37% plus state income taxes. However, if you retain that investment for more than a year and then sell it for profit, you will be taxed at the long-term capital gains rate, which is much lower. In fact, the federal long-term capital gains tax is only 15% if you earn between $47,000 and $518,000 per year, which may result in massive savings for anyone earning more than $50,000. It's even better if you make less than $94,000 per year as a married couple filing jointly. You'll owe nothing in long-term capital gains, which means that your profit is fully tax-free. As in, hypothetically, you might make $94,000 a year and pay the IRS zero. In addition, eligible dividends also receive the same long-term capital gains tax treatment on stocks held for more than 60 days on authorized U.S. and foreign companies. So keep that in mind the next time you decide to bet on short-term call options. In my opinion, the most advantageous course of action is to invest in long-term, broad-based index funds, which not only provide superior tax efficiency but also offer superior returns. However, as a self-employed individual, one of the most effective strategies is to establish an S corporation, which is essentially a legal entity you establish to conduct business. In other words, all of your self-employed income is contributed to the S corp expense. Permit me to elaborate in very simple terms. When you establish an E Corp, the E Corp becomes your employer and you become the employee. This means that you receive a modest base salary in the beginning, with the remainder of the profits being distributed to you at a later date. Why is this information significant? Medicare and Social Security taxes do not apply to distributions made by a S corporation, which should save you 15.3% of your money. For instance, if you operate a $120,000 profit business, pay yourself $60,000 annually, you will save over $9,000 in taxes by distributing the remaining $60,000 through a S corporation. Additionally, you can reduce tax costs by taking advantage of tax breaks. Unbeknownst to homeowners, there exist substantial tax benefits. Among these are capital gains exclusions, which permit tax-free sales of primary residences up to the initial $250,000 for profit if the homeowner is single, or $500,000 for profit if the homeowner is married, provided that they have resided in the property for 2 of the last 5 years. For instance, suppose an individual purchased a property for $500,000 in 2018, and it has since appreciated to $1 million. Typically, if one earns $500,000 annually, such an investment would be sufficient. The 1031-exchange is a tax-deferred sale method applicable to rental property owners. By exchanging one rental property for another within a specified period, one can avoid paying taxes on the sale proceeds. For instance, suppose an individual purchased a rental property for $100,000 that has since appreciated to $300,000. Typically, a profit of $200,000 would be subject to taxation. However, by utilizing a 1031 exchange, one could sell the property for $300,000 and reinvest the funds into a more substantial transaction. Moreover, the transaction would be completed without the need to pay any upfront taxes. This is something that owners of rental properties should take into consideration. On the other hand, to successfully implement these tactics for tax savings and tax reduction, one must be the owner of the rental property in question. Define a CPA. Individuals who have completed the Certified Public Accountant CPA exam and have satisfied the requirements for state licensing are considered to be Certified Public Accountant CPAs. Not only are certified public accountants able to provide clients with tax advice and aid with tax planning, but they are also able to represent clients in front of the Internal Revenue Service (IRS) or react to inquiries from state or municipal tax boards. Lastly, certified public accountants can offer advice on how to reduce one's overall tax burden. Can you please let me know in the comments whether or not you found this video to be enjoyable? Furthermore, I would appreciate it if you could let me know which other videos you would like to see. I hope to catch you in the next video. I am looking forward to it. Thank you for watching, and please like, share, and subscribe. See you later.